Robert Prechter is known for developing a theory of social causality called socionomics, and for his career applying and enhancing the wave principle, Elliott's fractal model of financial pricing. Prechter has authored and edited some 18 books, including a New York Times bestseller. His 2016 book, The Socionomic Theory of Finance, aims to replace conventional financial and macroeconomic theory with an internally and externally consistent paradigm based on socionomics. Please help me welcome Robert Prechter.
My job today is to keep you awake until Ron Williams speaks. So I'm going to do my best to do that. As you can see, my topic is toward a qualitative shift in the computerization of market analysis. Market analysis has been computerized for quite a few years now, but I think it's going in the wrong direction. And I'm not going to tell you very much today about what to do. I'm mostly going to talk about what not to do. Everybody knows the advantages of computerization. Rapid calculation and display. Computers never forget. Once you program something into them, it's there. Vast information processing. This is different from the speed. Human beings can only hold a certain number of concepts in their head at one time, but a computer can swing by and consider hundreds, if not thousands, of concepts virtually simultaneously. Probably the most important of all, computers have no emotions. They don't try to chase a trend. They don't try to fight the trend. They don't worry about whether they're going to lose clients. They don't get embarrassed if they're wrong on the market. They just coldly apply what they've been programmed to do. Is computer-driven quantitative analysis the answer? I don't think so. Now, I wrote this in my 2016 book. Quant researchers have spread a broad net, especially during the past 2 decades, trying to identify combinations of economic, intermarket, and intramarket variables that reliably predict financial prices. There seems to be little evidence that they've succeeded, whereas failures have been widely reported. And here's the most important thing. Since financial markets price changes exhibit a fractal form, which is independent of absolute quantitative causality, I suspect the quant quest will prove quixotic. You don't get to alliterate on cues very often, but it's kind of fun when you can do that. So 3 years ago, I basically said, the quant experiment isn't going to work because the market isn't built that way. Well, in the last year, there have been several major articles about the failure of quantitative analysis, or at least applied quantitative analysis. Now look at the top line. I've yellow highlighted 3 phrases. One is black box, the other one is rocket science, and the other one is inherent biases. These are 3 descriptions of what the quant programs are trying to do. Now I'm going to ask you a question. Which one of those do you think is the real problem? Is it the fact that it's black box, or rocket science, or the biases? You're probably going to be surprised at my answer. I don't think it's black box, because suppose the person who programmed it really did discover the secret to the universe. Just because he doesn't tell you doesn't mean it's wrong. Inherent biases, I think, are inevitable. That can't be the problem either. Everyone has an opinion about how the market works, and that's what's going to get programmed. The problem is rocket science. Because the stock market, the gold market, the debt market is not based on mechanics. Rocket science works because it uses the laws of physics in a mechanical world to design rockets and how they work. The stock market is not rockets. The stock market is human brains. And worse, human brains in conjunction with each other, where people are feeding off of each other emotionally and in mood form in all kinds of ways that do not pertain to rocket science. Now, this is an article from January, and it was saying, in recent years, the search has focused on proprietary quantitative strategies involving rule-based investments. That's fine. When you program a computer, you have to program rules. They have attracted $1.5 trillion under management. People fell in love with the idea of quant research. Now, the article goes on to critique quant work. It says, fancy math can't mask the fact that quantitative investing strategies essentially rely on pattern recognition. And my answer is, what's wrong with that? Of course we want to rely on recognizing patterns. That's what we're here for. Now, another problem, as it's pointing out, models look to correlate past periods of superior returns with specific factors, including value, size, volatility, yield, quality, and momentum. Those are key words, and we're going to explore all of those words in the coming slides and see if they're useful or not. Now, the second to last paragraph is very important. They're also trying to program what they call dislocations between individual prices and comparable securities or the broader market, betting that the relationship will eventually revert to normal. That's a problem. Why? This is rocket science again. If, for example, a physical system like the ocean has a sort of normal. Most of the time, the ocean has little white caps and maybe some rolling waves. Every now and then, a giant storm comes through, whips up the water. That's abnormal for most of the time. And then when the storm subsides, everything reverts to normal. This is not how human brains work. They do what they do, both rationally and impulsively and emotionally and so forth, but they never revert to anything that's normal, and they don't go crazy on occasion. They're crazy all the time. The last line, the article says, first of all, quant investing is tainted by hindsight bias, the belief that understanding the past allows the future to be predicted. Again, I say, what's wrong with that? You have to study history. The problem is not looking back. It's not the fact that it might be a black box. The problem is bigger than that. Now, here's another article. It came out in March and started to report on the problems with quant. Here's a fund called the Market Neutral Fund. It had the 6th quarterly decline in a row. Another one called the Neutral Fund, wouldn't you rather be neutral? Actually dropped 4% in 2 months. Another one down 3% in 2.5 months. Not a single popular factor has provided statistically significant excess returns since 2003. Okay? 16 years have gone by, and not one of the factors, remember those 5 factors that they said they used? None of them worked. One of the most popular factors, momentum, has extended a miserable 2018 into this year. Now think about it. 2018 in the US stock market was wildly swinging, but mostly sideways. 2019 up to this time was straight up. They lost money in both environments. That's bad. Value didn't work. Look at this last line. The challenge is diagnosing how serious it is. Actually, it's not a problem. None of the stuff worked. So we know the problem is very serious. What kind of problem is it? It's a fundamental problem. That's why it's serious. Here's the last of the articles we're going to talk about. This one came out 3 months later. It says quant funds were originally thought to outsmart human minds. Well, computers can outsmart human minds in some ways, but unfortunately, humans do the programming, don't they? So if they do the programming in the wrong direction, the computer's not going to do well. Now the funds are losing billions of dollars in their worst outflow in years. It names several ones that have shut down completely. That's how bad this quant research has been in the most fundamental of ways. And then it says trend following quants have suffered their worst outflows in at least 13 years. We didn't even mention trend following before. There was momentum and value and all those other things. Even the trend followers are losing money. Why? Because they're struggling to react fast enough to the unforeseen side effects of factors including the end of central bank stimulus. Wait a minute, that was unforeseen? I mean, everybody knew what the QE program was. Everybody knew when it was over. So they knew what it was. Well, apparently there were side effects that they didn't program into there. Now, my argument is there are no effects and no side effects. So it doesn't matter how much programming you do, you will not capture the answer. Look at this last line. My favorite one is, quants even seem to be shaken by US President Donald Trump. The models can't move as fast as the tweets. Okay, now if you have a model and your model is trying to follow tweets to decide what to buy and sell, I think you're lost already. Don't you? Okay, we have a problem. Quant programs are based on two things, widely speaking. External factors and internal market factors. Now, most of us think, okay, we know where we are, right? We'll see about that. Do extra market variables matter? First, we're going to look at all the things that they look at outside the market and see, are they really looking at something useful or are they wasting their time? I'll let you tell me. Most people believe that interest rates affect the stock market. Well, that's all well and good, except for the fact that I can show you times lasting years when stocks declined as interest rates went up. Here are two examples. When stocks went up as interest rates went down, well, that makes a lot of sense. You know, lower rates, better for stocks. But unfortunately, I can also show you major multi-year periods when stocks declined and interest rates declined. I can show you times when stocks went up as interest rates went up. And all of these last years, if not decades. So if you know the future of interest rates, do you know where the stock market is going? You do not. And this is a fractal. It happens on the short term too. There was a big argument back in 2015 that gold was going up and down with interest rates. And of course, the argument made perfect sense. As rates go up, who wants to hold gold because it doesn't pay? The problem is, the chart shows there is no relationship. There are times when gold goes up, T-bill yield goes up. Sometimes gold goes up and T-bill yield goes down. Sometimes it goes sideways and gold goes to the moon and then crashes. It goes its own way. It has nothing to do with these interest rates that I can see. And no statistician can see it either. Okay, most economists will tell you the oil market is a big impact. Notice that word impact. That's a word about physics. That's mechanics on the stock market. We did a 52-week correlation between the S&P on the top chart and crude oil prices in the middle chart. You'll see at the bottom, whenever the line is above the dark horizontal line, that's a positive relationship. They're going in the same direction. Underneath, they're going in opposite directions. Now, most economists tell you that they should go in opposite directions. But if you look at this history, which goes back quite a ways, it's actually a positive correlation more often than a negative for this period. Now, you might say, well, what about the short term? You can do this 52-week correlation. You can do a 52-day correlation. You can do a 52-month correlation. You can do a 52-hour correlation. And you know what you will find? The same thing. Sometimes they go together, sometimes they don't. So if you know the future of the price of oil, do you know where stocks are going? You do not. Now, this was a very difficult one at our firm because when the Federal Reserve of the United States announced that it was going to start buying $1 trillion worth of debt instruments, US government bonds and mortgages, for the unforeseeable future, everybody involved in the commodity markets, everybody involved in the precious metals markets said, this will send our investments to the moon. The fastest, most aggressive inflationary commitment ever made by a central bank at the time. At the top, we have a history of silver. At the bottom is gold. And you see that sliding horizontal line right here? That is the duration of the QE program, the most aggressive QE program ever. And look what happened to the metals. They topped out actually at a lower peak when the program started. They went down during the entire QE program, all the way down to here. In fact, the metals made a short-term low when the program ended. If you're looking at impact and causality as your paradigm of how the stock market works, you should conclude that anytime the Fed goes into a crazy, manic, inflationary episode, all the metals will go down. Now, that doesn't make any sense. It makes no sense. Markets don't make sense. Not this kind. They make another kind of sense. Okay, suppose, let me ask you a question. Suppose the central bank said, we are going to commit to buying a certain asset class with money that we can make out of thin air. Wouldn't you think the market would go wherever the central bank decided to buy, that would force the price higher? Most people think so. And most people do use that word, force the price higher, because the central bank is buying. Now, here's a history. This shows the annual gold price since 2000. And these bars show you that above zero, this is what all the central banks around were doing. The black bars indicate buying, and these gray bars indicate selling. So the history of gold looks as if the buying pushed it higher, and when they finally started to slow their buying, the market topped out, and when the market fell, they were doing the selling. There's only one problem with this chart. Are you very sharp-eyed? Have you read this little thing down here? It says fake data. Now I'll show you the real data. The central banks were selling and selling and selling all during the bull market. And when they finally bought a lot, that was the top year. And they had been buying ever since. This is only through 2015, because it comes out of my book. So what does this tell you? Central banks cannot even force up a market that they buy directly. Physics doesn't work in the stock market. The quants are trying to program this. They will program what are the forces of central banking. Are they buying gold? Let's be long. Are they selling gold? Let's be short. They would be wrong for 10 years on the upside and then wrong ever since on the downside. What does this chart really show you? You're technicians, you should know. It shows you that central banks are terrible investors. They're what the old timers used to call odd lotters. The people would buy 3 shares of a stock. They were always wrong. These guys are worse. Okay, do the Fed's interest rate decisions matter to financial markets? Almost everybody I know says yes. And everybody cares deeply about whether the Fed is going to raise or lower its interest rate. We have been studying the Fed going back 100 years, and we noticed something very interesting. The Fed does not set any rates. All it does is follow the Treasury bill rate. It's been doing it for 100 years, and only once did anyone of it admit it. When Alan Greenspan was under pressure one time about why he kept rates so low, he said the market did. I'm sure he slapped his mouth afterwards because they haven't revealed that to people. But we noticed it, and we've been applying it regularly for years. Here's a great example. We published this in 2007, and we said, look, here's the T-bill rate in the jagged line. The dashed line is the Fed. Notice how they're lagging all the way. They've been keeping the rate high, but the T-bill rate had fallen sharply. And we said, the Fed's going to follow. That's what they do. And we found out by doing the calculations, we went to the Fed, we went to the British Central Bank, the European Central Bank, the Australian Central Bank, they're all doing the same thing. The average lag is 5 months. That's average, doesn't happen every time. We said the Fed will soon follow, and sure enough, it followed. They started lowering their rates to follow the market and went all the way down to here. We did it again this year, in June. This was published by Steve Hochberg and Pete Kendall, who work with me. And they wrote in June, over here, we expect the Fed to change course soon. The market is signaling that at some point in coming months, the Fed will lower its Fed fund rate to align with T-bill rates. And we showed this chart, and it's the same picture. Rates were falling, the Fed was holding up, they were going to have to change their minds, and sure enough, that's exactly what they did. They went lower. And so they concluded over there, once again, the Fed has simply followed the freely traded T-bill markets in its decision. So, if you're a quant, do you program in whatever the Fed did today? Why would you want to program in an indicator that lags the market by 5 months? If you think, interest rates matter, you should at least plug in the T-bill rate and not the Fed. Okay, outside forces. We've been talking about outside forces, interest rates, the oil price, and so on. They don't work. There's no correlation that you can name that works. But do they make sense? Now you might think, oh, I know, Bob's going to say, no, they don't make any sense. Well, you're wrong. Let's examine some, and we'll see if they make sense. Are rising oil prices bullish or bearish for stocks? The answer is yes. Rising oil prices are bearish for stocks because they raise costs to businesses and consumers. That makes sense. But wait a minute. Rising oil prices are bullish for stocks because they indicate a robust economy with a strong demand for energy. That's true too, isn't it? What about this question? Is inflation bullish or bearish for stocks? Well, inflation is bullish for stocks because it causes all prices to rise. Right? That's perfectly sensible. But wait, inflation is bearish for stocks because it raises the cost of production and causes a misallocation of resources. That's true too. How about this one? Are higher interest rates bullish or bearish for stocks? You could say higher interest rates are bearish for stocks. Most people believe that because they raise the cost of borrowing. Well, sure, if it costs more to borrow, that's not good for business, is it? But wait, higher interest rates are bullish for stocks because they indicate a robust economy with an increasing demand for credit. That's true too. When the economy is really pumping, people need to borrow more money. That's why rates go up when stocks go up. So the answer again to the question is yes. They're bullish or bearish. Is full employment bullish or bearish for stocks? Well, economists might tell you that full employment is bullish for stocks because it means that everyone is working. Well, if everyone's working, that's good for the economy. That's bullish, right? Someone else might say, wait a minute. Less than full employment is bullish for stocks because it means there is room to grow. Well, that's true too. Will the new tax be bullish or bearish for stocks? Again, the answer is yes. The new tax will be bearish for stocks because it will take money away from businesses and consumers. That's true. But it's also true that the new tax will be bullish for stocks because it will pay for new infrastructure. Companies can't work without infrastructure, right? Are bank bailouts bullish or bearish for stocks? We ran into this back in 2007, 2008. Well, bank bailouts are bullish for stocks because they keep the financial system from collapsing. But wait, bank bailouts are bearish for stocks because they create a moral hazard that will ultimately cause the financial system to collapse. Okay? So you got the same action, and one's going to make the system collapse, and the others are going to save it. Both arguments make sense. How do you program that if you're a quant? Outside forces always make sense. That's why they never work. Because whatever you say makes sense. If it makes sense to be bullish about an action, and it makes sense to be bearish about an action, how could you possibly make money from that? So what's the purpose of all these arguments? The purpose is to serve rationalization. Bullish people quote the bullish arguments. Bearish people quote the bearish arguments. That's all there is to it. The so-called effective argument and logic is irrelevant because you can argue both sides just as passionately, just as logically, and just as worthlessly. Okay, now some people say, wait a minute, Bob, you're talking about all these forces. Some things are purely negative or purely positive. They don't have two sides. And you know what? I agree. For example, terrorist attacks. Hard to make a bullish case for that, right? Except that the history doesn't seem to bear out the argument. Now here's one I'd like to show you. In the United States, back in 2001, there was a series of envelopes being sent to very important people containing a deadly strain of anthrax. And these were terrorist events. The first one, that you can see the arrow shows that it occurred on the top. Here's another one, another one, another one, another one. And right here was a headline, Anthrax Fears Fade. And then the market apparently turned around and straight went back up. So you might look at that and say, okay, you see, there's one time where it's just purely negative event, and there's nothing you can do about arguing the other side. But again, now that I already hinted where you should keep your eyes, this is fake data 2. I'll show you where they really happened. The first anthrax attack occurred on the bottom day of the crash of 2001. They continued all the way through the biggest rally on this entire chart. And when the headline came out, Anthrax Fears Fade, that was a peak, and the market immediately collapsed to a new low for the year. So if you looked at this, and you believe in the mechanical paradigm, the physics paradigm, the rocket science paradigm, you couldn't make sense of this. Because it looks as if the market thought these attacks were bullish, and as soon as they stopped, everybody sold stocks. This isn't the only example we have. Remember, there was an attack on the Charlie Hebdo offices in Paris back in 2015. These are intraday charts. We're only looking at 3 days of action. And in those 3 days, when the reports occurred about the attack, the market gapped up the next morning. Not down, up. And as the attacks were continuing, the market was rallying. As soon as they started catching people and locking them up, the market topped out and immediately sold off. Completely the opposite of what you would think. Now, I don't think it's because these events made the market move. I think that they just happened at the same time. It was random. All right, we've been talking about external market variables for the last 20 minutes. Now we're going to look at some internal market variables where we live. This is where technicians live. What about valuation variables? Okay, valuation variables, kind of interesting, but they have a quantitative problem. You can look, for example, at a 100-year history of the S&P's earnings ratio, price earnings ratio, and you find it has a range of 14 times. So even knowing a number, you wouldn't know, relatively speaking, whether the S&P should be trading at 100 or 7 or somewhere in between. We've got a history of the dividend payout from the Dow. Again, a 14 times range over the last 100 years. You don't know if the S&P or the Dow should be priced at 100 or 7 or somewhere in between. Here's a history of the S&P 400 and its book value. This has a 19 times range over the last 100 years. You don't know whether the index should be at 100 or 6. This is the bond yield, stock yield ratio. How much do bonds yield? How much do stocks yield? And what's the relationship? A lot of people think that interest rates are important relative to stock payouts. They're not. This one has a range of 21 times. So you don't know whether the S&P should be priced at 100 or 5 or somewhere in between. That's an amazing thing. Now think about this. We're talking about an index of 500 stocks, so that's very smooth. We're talking about yearly averages. Those are very smooth. Can you imagine the ranges when you get down to a single stocks? Or a daily or a weekly or a monthly basis? These ranges go much wider. So if you know the dividend payout, or you know the book value, you know the PE ratio, you don't know anything about where the price of the stock is going to go. So remember the quant programs were using valuation indicators? How in the world could they possibly use them? What about sentiment indicators? I happen to like sentiment indicators, but they have a quantitative problem too, and I'm going to show you just one. This is the percentage of cash held by managers of mutual funds, okay? Usually, they have less cash near a top and more cash near a bottom. And if you go back here into the late 1960s, early 1970s, you can see every time the cash ratio fell below 5%, the market was nearing a top. And when it got down here in the 9% area, it was a bottom. So if you were a quant program, what would you program? You would program in the sentiment indicators that whenever it's below 5% cash, we want to be bearish, and when it gets down here, we want to be bullish. Well, that was all well and good until here. 1998. It crossed the 5% line, kind of held up here, never got into 9% bullish territory. For 21 years, this indicator has mostly been above or below the 5% cash area. So, during that time, what's the S&P done? It's tripled. So you got your sell here on a long-term basis, and all it did was get worse and worse and worse and worse. So the problem isn't the indicator. The indicator is telling you the truth. It may be telling you something really important on a very long-term basis. But you see, the quant people are looking for quantities. So they said 5% is our quantity. That quantity killed them throughout this period. Momentum indicators definitely have a quantitative problem. And we're going to just show one here as well. This is the S&P 500. Underneath, we have the annual rate of change. That's a 12-month net difference in price. Now, we could just be talking about overbought and oversold, but that's too simple for us, right? We know about non-confirmations, momentum divergences. So we're going to look at a little more sophisticated approach here and see when the rate of change was telling you there was a sell signal based on divergence. First of all, if you go back here to 1929, there was no divergence. The market went straight up and then crashed, and there was no sell signal. It never showed you any slowing on this indicator. Okay, let's get over here to the 1950s and 60s. 13 years from the peak in momentum, and then you had another lower peak, and a lower peak there, and a lower peak there, and a lower peak there. It spent 13 years giving you lower peaks while the market went up and up and up. Finally, you got your bear market. But what happened? Even at the very low, it wasn't as low as it was when this whole series started. So it kind of worked, but you lost money. This one was the worst imaginable. 11 years, a period of declining upside momentum, right into 1994. But instead of rolling over into bear market as it did back here, what happened? The market accelerated out of it. So you didn't even get your top. So then, how do you program that? And what do you say now? Here we are, it's been 10 years, lessening momentum on the upside. So the question is it going to resolve like this one into a bear market? Or is it going to resolve like this one, where it just holds up and all of a sudden just goes to the moon? You don't know. It's a momentum indicator. It has quantities. The market doesn't care about quantities. Time cycles are a problem. I used to use them, and they helped me make some pinpoint calls, and they also embarrassed me several times. What's the problem with them? They are tied to quantities. That's the problem. Here's an example. I showed this chart way back in 1993. There appeared to be a nice 3-year cycle. It caught the first low back in 1978, another one in 1981, the momentum low there. 1984, caught that low. Crash low of 1987, another good low in 1990. So here we are. In late 93, this cycle should be providing a bottom. Or so we thought. It didn't. The next 3 cycles failed, and failed. The market, they were at tops, they were at acceleration points, they were in the middle of nowhere. The 3-year cycle just went away. Why? Because the market doesn't work on quantities. Now, remember the people who were saying, let's go back and we'll pull some data out of the market? They would have pulled a 3-year cycle out of the market and it would have failed. That's what the quants are doing. They're looking for things in the market they can rely on, but they can't do it. So why is this true? Why are we finding all these answers? Why is quantitative analysis doomed to fail? The answer is there are no quantitative absolutes in financial markets. Why? We said it on the second slide, because financial market pricing forms a fractal. A fractal is irregularity at all scales. All scales. There is no quantity that repeats often enough that you can make money. Now, because the market is a fractal, does that mean it's impossible to make money from that? Does it mean we're doomed? No, but it means the quants are doomed. And even some people who believe the market is a fractal can't use it to make money. In my opinion, people should have abandoned quantitative analysis in 1982. Forget R.N. Elliott's 1938, because most people didn't believe it. But when Benoit Mandelbrot came out with his book in 1982, The Fractal Geometry of Nature, and he showed that cotton prices and stock prices were all a fractal, they should have thrown the quantitative programs out the window. They didn't do that. But you can't even use Mandelbrot's approach, and I'll show you why. Edgar Peters, who was reviewing his work, said coastlines are good examples of random fractals. Stock prices are comparable to coastlines. In other words, they're random. If they're random, you can't predict, right? Now, Mandelbrot agreed. He said, I agree with the orthodox economists that stock prices are probably not predictable in any useful sense of the term. This is the guy who told us that mathematically the markets are a fractal. He said, but they're indefinite. They're random. We can't get anything out of them. So as I conclude here at the bottom, indefinite fractals have no predictable aspect of form. Like coastlines, they meander, but they don't go in waves. They don't say, well, they're going to be a small one and then a big one. You don't know. There's no form that you can rely on. Clouds, same way. They have all kinds of different cloudy shapes, but there's not anything that tells you if one is puffed up to the east, you'll get another one on the west. It doesn't work that way. There's a different type of fractal than Mandelbrot or the people following him were paying attention to. And that's what I call a robust fractal. A robust fractal is self-similar, and it occurs in nature, which is a good thing because human beings are part of nature. The wave principle model is the only non-quantitative, it's non-quant, non-indefinite model of financial market pricing. Now I'll give you an example of a robust fractal in nature. It's branching systems. We have branching systems all through our body. We have our circulatory system, our bronchial tube system, nerves, all follow branching systems. This is a picture of a tree. Now, it's not random, but it's not self-identical, not like, say, nested squares. It's just self-similar, meaning that each branch that comes out of another branch looks a lot like the whole tree. Not exactly, but a lot. But still, it has rules. Clouds and seacoasts don't have rules. One rule a tree has, for example, is that when a branch is coming out, it's going to be smaller in diameter than the branch from which it came. That's a nice little rule. Elliott waves also have rules, and they are also robust, hierarchical fractals. Just as trees have smaller components that are attached to the larger ones, Elliott waves have smaller components that make up the larger waves. And just like a tree, human society is living. It's part of life. And human actions create robust fractals called Elliott waves. Now, I think Elliott waves are waves of social mood or market mood. They have nothing to do with outside forces. That's why they don't work. Outside forces are not the cause of these movements. Outside forces or outside events are the results of waves of social mood. Social mood waves are what create all these things in the first place. They create people who raise and lower interest rates. They impel people to have terrorist attacks or start wars or have peaceful times. It's the result rather than not the cause. Okay, now, Elliott wave analysis is not easy. It takes work. I've been doing this my whole life. You've got to spend a lot of time poring over a chart. And you'll see why I'm going here once we get through this. I'm going to show you some charts of Elliott Wave analysis that we published near a major turn, up and down, in a couple of different markets. We showed this chart in September 2011. As you can see, we had to count all these waves internally. We had to figure out where the channel was. We channeled the last wave as well, and we said this is what Elliott called a throwover. We're above the channel. If it falls back below, the throwover will be complete and the top will be in. And it did complete. Steve and Pete published this chart in October, a month later, and said, the bull market's over. Now I have to tell you, on the way up, we were wrong a lot. We missed a lot of these waves on the way up. But once we finally got in the fifth wave, we recognized it. So we were working hard, we're trying to look at all the options, we're labeling all the internals very, very carefully. Here is the aftermath. After that top, gold, as you know, fell for a number of years, and now we're getting close to a low. You can see we've counted 1 down, 2 up, nice ABC rally. Third wave's usually the longest and strongest. We thought 4 might be ending here, but after this, and oh, it's a triangle, I see. So that's the 4th wave. And then comes, was that the end? We thought that might be the 5th wave. But then we had this rally, we had this decline. Oh, it's a diagonal. So then Steve and Pete published this chart in November 2015. We're getting very close. We need one more new low. And we got it. And this actually went out on the 4th of December, 2015. Go look it up. It's within a day or two of the low. But you see what we had to go through just to get there. We're counting all these internal waves, and we're not sure. Finally, we see the truth, and then we go. So it takes a lot of work. As the rally started from that low, which, by the way, was back here, Steve recognized, okay, we had wave A, and now we've been in B, and we think it's a triangle because these are 3-wave structures. That's a pretty cool prediction, I think. We had to go a little lower in C, then we're going to rally in D. We're not going to go above this line, pull back in E, and have one sharp rally up into this area. That's what happened. This is a chart that I published 2 months ago. Shows the same count all the way down. But look, we're counting, we're drawing lines, we're drawing channels. We've got our A wave, we've got the triangle finished over here. We had our thrust. This was a target zone we put out way in 2016. My point here is to show you the work that goes into it. And we're going to see why in a minute. This is the last one of these charts. This is a chart I also published 2 months ago. Now, I don't know if these are going to turn out right, but it was quite a clear structure, at least I think. We had a wave 1 down here with a nice 5-wave subdivision. Wave 2, we had a 5-wave subdivision for 3. Nice triangle 4, final move down. That was wave 1. This, by the way, is the long bond futures contract. Very different from the yield on 30-year treasuries or 10-year treasuries. So I didn't talk about these for years, and finally in August I said, I think I can count ABC up, and this should be over. It went up for 2 more weeks, had a very sharp drop. We don't know if that's it, but look at the work. You know, we have to look at all this and weigh all the rules and guidelines of Elliott Wave principle to figure out how we label it. And then we have to have the strength or the fortitude to come out and say our opinion. When I put my lines and labels on there, you go, oh yeah, I see, 5 waves, okay, ABC, I got it. Well, try doing it yourself. It's not quite as easy, is it? Do you know where the labels go on here? Now, I'll tell you something. This is not a market chart. If I showed you a market chart, it might be more difficult. This is a computer-generated, idealized Elliott Wave. Every rule and guideline is in there. If you know the rules and guidelines of Elliott, you should have very little trouble labeling this. But as you can see, when I don't tell you what the labels are, oh, I guess I need to sit down and study this for a while. This is going to take a little bit of time. Anyway, that's where the waves go. It's an upward correction, an upward flat. Let's try one more. How would you label these waves? You know, is that some kind of low here? Or is this a 1, 2, 3, and we're going to blast off to the upside? What do you think that is? Remember, this is computer generated according to the rules and guidelines of Elliott, so there's nothing, everything is perfect. So if it doesn't come to you quickly, you realize, I'm going to have to sit down and study this. It's a triangle, a very pretty triangle. In fact, it's a perfect triangle. So what do we want to do to get into the future? First of all, we have to understand what Elliott waves are well enough to benefit from them. And by the way, I'm very proud that Elliott Wave International has partnered with IFTA to test people who want to prove that they are good Elliott Wave analysts. It's called CEWA, the Certified Elliott Wave Analyst. And this is only here, so if you're at all interested, you can write this address down, right up here. Because even where we're about to go, we're going to talk about computers again, if you know enough about it, you'll be able to understand what the computer is telling you. The future is still computers. Now, I talked for a long time about what we're doing wrong in computers. Now I want to talk about what we can do right. First of all, they still have rapid calculation. They never forget. Vast information processing, and they have no emotions. Now, wouldn't that be useful to track Elliott waves with? I think it would. Well, recently there was an article by one of the biggest gurus of the quant universe. And he said, yes, I see all the funds are failing. All of our approaches are failing. He said, but we can fix it. First of all, we've got to get rid of these econo-quants. These are people that think the market should do a certain thing because of their economic studies, and they program it in there, and it's all wrong. He said, we're just going to go with math quants, pure mathematicians, and they will figure out what the market is, what secrets the market is holding. And the next thing he said was, machine learning will beat programmed analysis. Now, first of all, I think that's hilarious. First of all, it says, nobody knows anything about the market because all the programmers must have failed for him to say, we don't want to program anymore. So apparently, no human being understands anything about any market at all. If they did, you'd program it and it would work. But he's saying, no, programmers don't know anything. So what are we going to do? We're going to tell the machine to go learn. Well, that's not going to work. Why is it going to work? Math quants and machine learning will fail unless programmers avoid researching absolute quantities in financial markets. We've shown that for the last 45 minutes. Absolute quantities don't work. So what do these programmers do? They say, machine, we want you to learn. Now you go and see the last time the market fell 8% in 4 days, what did it mean? So the computer does that. It says, I'm going to go learn that. And it learns it. And it says, well, the last 6 times it happened, here's what the market did over the next 1 day, 2 days, 10 days, and so forth. And do you know what that's worth? Nothing. Because a fractal doesn't care. Next time, it could be completely different, wildly different, just like that 5% cash thing. It could be something so far different you can't imagine. And they can't imagine. And because they're programming the computer to only imagine the way they do, all the learning in the world is not going to save them. Oh, another thing. If you want to build a fractal analysis Elliott Wave program, you can't fake it. We've looked into some other programs that people have tried to build, and we found that they found the task too daunting, it's too difficult. So they use momentum indicators behind the scenes. And if it's really overbought, oh, that must be a third wave. And if it's lesser overbought, oh, that must be a fifth wave. But remember that momentum chart we looked at? You don't know if it's a fifth wave. It could be the fifth wave of the third wave. It could be a corrective wave rally. It could be all kinds of things because they're not looking at the patterns. They're using the easy stuff, momentum indicators. We looked at a few other of those attempts, and we found that they were actually doing retrospective analysis. So they saw low and they saw high, so they went ahead and put the label on there. We'll call that a 1, and then we'll tell the computer, find the biggest subdivisions and just put labels on them, 1, 2, 3, 4, 5. Well, that's fine if it's 5, but what if it's an ABC? They still put 5, because all they know is that they have turning points. So you can't fake it. If you're going to program an Elliott Wave analysis computer, you have to program Elliott Wave analysis the way a human does it. So we had a goal, and the goal was the computerization of qualitative, not quantitative, what we call qualitative, robust fractal, not random fractal, not indefinite fractal, the robust fractal, the self-similarity. Pattern recognizing, that means not data mining. This isn't telling the computer to go mine data. We want it to recognize patterns. Real time, not retrospective. We want it to count up to today. And even better, future anticipating. We want it to think like a human. If I have put 1, 2, 3, 4, what's next? Well, we know what's next. The 5th wave should come. Where should it go? We want the computer to think like we do. Well, maybe it'll go to the upper end of the channel. What's the minimum it should go? What's the maximum? What's the statistical average extent, and so forth? We want to have all that right at our fingertips today, or maybe the minute that we're looking at an intraday chart. So we came up with something we have been working on for years called E-Waves. It's the Elliott Wave Analysis and Validation Expert System. And we put a lot of time into this, a lot of money into this. I think this is maybe not the right path for computerizing financial analysis, but it's certainly a better path than the quant analysts have been going. Because we are looking at relative quantities, we are looking at pattern structures. Do you remember the Elliott Wave patterns I showed you about 10 minutes ago, and you saw the increasing degrees of trend? Was there any time indicated there? No. Was there any height indicated? No. Fractals don't care about those things. They just care about pattern. So you can see that pattern on a daily chart, you can see that pattern on a monthly chart, and even on a decade by decade chart. So what you want to do is have a program that is tracking patterns and tell it, don't worry about how long it takes. Don't worry about the price sizes. Just make sure that they are relatively in sync with each other. Remember we talked about the branches coming out of a tree being smaller in diameter than the branch it came out of? Same thing is true here. It's those relative quantities that tell you things, not absolute quantities. So our program has no quant analysis at all. Has no momentum, no value, no sentiment, no rates of change, nothing. Except Elliott Wave patterns and all the rules and all the guidelines and all the relationships and the statistical measures of all those historically. And our firm is unique because we've got 100 years of analytical work. When you add up all the people who published at our firm, of wave counts to use as basic structures. So, remember we showed you how much work it takes. This is why I went through that to say when you look at a chart, it's not always self-evident what it's doing. Sometimes it is. This is a very clear chart, and most of you will recognize exactly what time period this is. But even if you look at that and glance and say, you know, I can put my labels on there rather quickly, you still can't do it this fast. And that's how fast a computer can do it when it's programmed to suss out and figure out Elliott waves. Now, I spent all this time telling you what not to do. And I kind of hinted at what I think we should do. If you want to learn a little more about what we should do and what we have done, and you know, I'm an old timer. I used to keep my charts by hand. I put the hourly dots in by hand. And I've done all of the analysis here. I haven't used the computer before. But I think the future is computers, but it's only computers properly programmed. And that's what Elliott Prechter will be talking about tomorrow at 9 o'clock. I want to conclude by saying that I've only been here 2 days and I've already enjoyed Cairo more than I imagined I would. We've had a terrific time here. I've found the Egyptian people to be beyond friendly. They're just really good people to know. I'm glad that IFTA has decided to hold this conference in the Middle East. It's been a total pleasure. I plan to be around this afternoon and much of tomorrow as well. So if you have any questions about anything we talked about today, come find me. I'm a pretty friendly guy too. So just come up and say hello. Thank you. Have a wonderful afternoon.